Howdy, Jacob here. Today we're looking at Ternium. Some of the financials, we see that they're a $7.6 billion market cap and a $4.5 billion enterprise value. So very interesting to see that their net positive debt is um, negative in the fact that they have a lot more cash on hand than debt. And then they have a 7.4% dividend yield. So quite substantial. It looks like they manufacture, process, and sell various steel products in Mexico, Argentina, Paraguay, Chile, Bolivia, Uruguay, Brazil, and the United States, and a lot of other places. So it looks like Central America, South America, U.S. status. I guess I could have just said the Americas. Revenue 8.5 billion 10 years ago, up to 16.4 billion in 2022. That's interesting to see. I wonder if that's mix of inflation and acquisitions. We'll look at the cash flow statement in a sec. Gross margin relatively flat, 22.6%, 23.9%. And then operating margin 13.0% 10 years ago to 17%. So operating margin up a bit. We see that outside of COVID, they've paid a dividend every other year. And it looks like they've actually increased it quite a bit post-COVID. And then we can see that earnings have actually shot up quite a bit since then. Let's look at that balance sheet. We see that they only have 533 million in long-term debt, 499 million in short-term debt, so about a billion in debt there. And then both cash equivalents and short-term investments, we're looking at just under 4 billion, about 3.7 billion dollars. That's great to see. That was just poor math. $3.5 billion in cash equivalent assets, very liquid assets, and less just over a billion in debt, both long-term and short-term. So that's great to see. Very healthy balance sheet. 5-year average free cash flow, let's say, is a 1.5 billion, because we have as low as 600 million, but then as high as 2.1, 2.2 billion. So let's say about 1.5 billion 5-year average free cash flow. Their dividend is paying out about a little over 500 million. So we're looking at a third payout ratio, making a lot of investments. Outside of that, they're buying down a little bit of that debt, which is good to see. So, return on invested capital. So I was looking at they had a pretty good investments, pretty good amount going into investments, and they can get a very good return on invested capital. Somewhat cyclicalness, but we're still looking at probably low double digits on a 5-year average basis. And so that's pretty good return on invested capital that we see. And I think I'm ready to start making some assumptions. So let's say revenue. What was the acquisition? So just a huge one in 2017, and then otherwise pretty organic growth. Okay. I would see them grow about 3% a year. And then again, saying that 13 price earnings and free cash flow in 7 years, where they're still going to have growth ahead of them, likely 15% discount rate. And then we'll take a rough estimation on earnings on an average basis here. Let's just do 11 and 10. And then 0% share change. And then, it looks like they can afford that dividend because it's a third right now. So it's actually looking very promising from initial review. It's saying that it's definitely a deal right now. So this will be a company I'll have to go farther in depth on. Hopefully soon. I think that right now it looks pretty reasonable, but obviously we'll have to look further into it to see if these assumptions make sense to us or not, and or make sense to me. Hopefully everyone else is doing their own research as well. I'm just here to bring about ideas and shed my perspective, but don't take it to heart. Hopefully everyone enjoyed the video and has a great rest of the day. Thank you.